Hi folks, welcome back to this video where we left off looking at long-term non-interest bearing notes. And if you'll remember, we said with a non-interest bearing note, the interest rate is implied. We calculated the interest rate because we're going to need to use that to calculate our interest revenue that GLE, the issuer of the note, is going to book each year for the next 3 years of the note. So you'll remember that we did a present value or a calculation here to calculate our I/Y because we're going to use it later. The question did already give us the amount of money that GLE would give SAD and how much SAD would have to repay GLE at the end of 3 years. So we know that we set up the note receivable and credit cash for the amount that GLE has loaned SAD, $71,178. So now if we move forward, we're going to prepare an amortization table. And the table will show us exactly how much interest revenue GLE will book and how much they will increase their note receivable. Because don't forget, at the beginning or issue date of the note is sitting at its carrying value or present value of $71,178. But we know that SAD has to pay GLE back $100,000. So what we need to do is we need to figure out how much are we going to debit the note and credit the interest revenue for to bring the note up from its current carrying value to its ending value, which represents the amount that SAD pays them back. So let's begin. You'll notice here I have a column that's grayed out. I'll explain that in a moment. What I want to do right now is just go through the headings here so that we know exactly what we're dealing with in the table. We've got a period ended, so these here will be the period end, and as you know, I like to start off with the issue date so you know your starting point. The amount of cash interest that GLE is going to receive from SAD, and in this case, because they're paying back the $100,000 at the end and the note is non-interest bearing, any interest that's going to be paid by SAD to GLE is not going to happen every period because the note's non-interest bearing. When we book our interest revenue, notice what we do. Interest revenue is going to be, because we're using the effective interest method based on the carrying value of the note to open the period within which we're calculating our interest revenue. We also have a column to amortize the discount on the note. You remember earlier we had calculated the discount on the note at the date it was issued, and we calculated that up here to be $28,822. And what we said is that every year for 3 years, we're going to take some of that $28,822 interest revenue. When we do that, we book the interest revenue through a credit to that account. But what do we debit? Don't forget, we've got to move our note receivable from $71,178 so that at the end of the year, it's end of the 3 year period, it's sitting at $100,000. So that's going to be the exact amount that we're going to debit the note receivable by, the amount we amortize this discount by. Now, the unamortized discount is basically what we started with, less any of the amounts that we actually amortize to the note. The reason I have the column grayed out is that you'll notice in many textbooks, including our own, we don't really use the unamortized discount column very much. Because the normal presentation is to show the note receivable on the statement of financial position using the carrying value only, this column. So we find that we don't use this very much in practice. But because I know some of you are quite comfortable with it, I'll show you how to do the balance sheet presentation using the unamortized discount. So I'll show you a couple of different ways of doing things. But in this case, in one of the cases, we'll actually use this column just to kind of build a comfort level for you. So now, the objective in the table here is to show how much interest revenue we'll book and how much discount we'll amortize such that we use it to increase the note. So we already know the carrying value of the note, $71,178. If we multiply it by our yield, which we calculated earlier, we're going to get $8,541. That's the amount that we'll amortize the discount by. So we'll only have unamortized discount of $20,281. That means that's the unamortized discount we started with, $28,822, less how much of that we amortized, which is $8,541 when we debited the note. And that will be left. So therefore, if we take the carrying value of the note at the date it was issued, plus the amount of the discount that we amortized, we can add this piece to the note and we'd get $79,719. So that really equals $71,178 plus 8541 that we booked through the amortization of the discount. So I would kind of say, maybe there's a little bit of overkill here, but I love to draw. This guy comes from here. Because don't forget, this is your interest revenue column. This is the column here that's going to adjust your note, and that's what we're doing here, adjusting the note. So we take the previous period's balance, which opens the period, beginning year 1, plus the amount that we amortize in year 1, which is 8541, which is going to give us $79,719. We do this all the way down. So we're going to take $79,719, multiply it by our yield to get $95.66. That's exactly the amount that we're going to amortize the discount by. So when we add the amortized discount to the ending carrying value of the note at the end of the previous period, we're going to get $89,285. 12% of the $89,285, which is the carrying value of the note to open year 3, is $10,715. That's exactly the amount that we'll debit the note by in order to increase it to $100,000, at which time we have no remaining discount to amortize. So you'll notice I've got some color coding going on here. The reason I did is I wanted to show you that anything in red is where a credit to revenue is going to happen, and anything in purple gives us a debit to the note receivable. You'll notice that at retirement, once the note is fully sitting at its $100,000 amount, which is the amount that SAD has to pay GLE back, then GLE receives this $100,000 from SAD and they retire the note receivable. So this should be the entry that you would always do when you have a long-term note. All right? When you have a long-term note, whether it's interest-bearing or non-interest-bearing, doesn't matter. Now, we're going to show you how to use this unamortized discount column that we referred to earlier a little bit later as we start showing you how the financial statement presentation would look at the end of each of years 1, 2, and 3. Now, in your text, they use the presentation of the receivable at net every period. So, because we're at the end of year 1 and it's a 3-year note, we know the note receivable is non-current. Because the note is an investment for GLE, because they're earning interest on it, they're earning interest because we're booking interest revenue, right? We're going to put it as a long-term investment because the investment, by definition, is giving us a return, which is interest. So we're going to show the receivable, note receivable at net, $79,719, which is exactly what we would have at the end of year 1, according to our table. At the end of year 2, we're going to show it at $89,285, but notice it's not in the long-term investment section. Now it's in the current asset section, because at the end of year 2, it's going to be retired at the end of year 3 when SAD pays GLE back. So therefore, the note is only going to be outstanding at the end of year 2 for an additional year. So therefore, by definition, it's current. So we show it at net. I should have just put at net here. Okay. And that will bring us to the end of year 2. Notice at the end of year 3, I've got N/A, which is not applicable, because don't forget at retirement, the end of year 3, SAD paid GLE. So now when we post this credit to the note receivable, it's going to be removed from GLE's books, so it will no longer have a note receivable. So it's 0, or in our case, not applicable. Now, if we wanted to do the statement of financial position using the unamortized discount, that's the column we have up here, this unamortized discount column, all we would do is in each year take the note at its ending value and deduct the unamortized discount in order to get the carrying value. So every year we would take the $100,000, which is the face value of the note, and we would reduce it by the amount of the unamortized discount each period. Well, don't forget, we're only doing year 1, year 2, and year 3. So don't forget, we'll take $100,000 and we would reduce it by $20,281 in order to get $79,719. So here's what it would look like if you were doing your statement of financial position using that presentation. We'd have our note at its face value, less the unamortized discount at the end of year one, which again we showed you can get right from your table, all right? And that will give you the note receivable at net $79,719. At the end of year two, we're going to do the same thing, only the unamortized discount at the end of year two is significantly less. It's $10,715. So therefore, you'll see that we have left $89,285 at the end of year two on our note. And again, it's in the current asset section. At the end of year three, don't forget, the balance of our note is zero because SAD has paid Glee back. Now, our last example here deals with a long-term interest-bearing note. Okay, folks, welcome back. Now we're going to look at an example of a long-term interest-bearing note. So here now we've got Glee issuing a 10% 3-year interest-bearing note. So there's your coupon. It's stated now, right? Glee expects to receive $100,000 at the end of the 3-year period. Notes of similar risk charge 12%. So here's the difference. We've got this coupon of 10% stated because every year SAD is going to pay Glee 10% of $100,000, right? So in other words, every year SAD is going to make a payment to Glee of $100,000, which is the face value of the note, or what they expect to be getting, times 10%, and that's going to be $10,000. All right. Now we're going to use the 12% to calculate the interest revenue, just as we did earlier. So now you're going to see that there's a difference in the actual numbers that we use, because now when we're calculating the carrying value of the note at the issue date, we have to do a present value calculation. Why? Because the question didn't give us what the carrying value of the note was at the issue date, or its present value. All they said is that we're going to loan you money. We expect to get 10% back. We expect to get 10% back, which is 10% of 100,000, and we expect to get the amount paid back in full at the end of 3 years. And from SAD's perspective, if it's a 10% note and they would have to charge 12% normally, then SAD is getting a deal. So SAD's probably going to do this deal with Glee, and if they did, we have to calculate that present value, all right, of the note, so that we know how much to record it by, and we have all the information that we need to do that. So we're going to use our future value of 100,000. Our I/Y is our yield, which is 12. This time we have a PMT of 10 because, again, each year SAD will pay Glee 10,000. We have N is 3, so the note will close up at the end of 3 years. And if we do a compute PV, again, because it's going to be an outflow, I put a plus minus, and we have here that Glee will pay out $95,196 and set up a note receivable for that amount. Now, we set up the table in a very similar fashion that we did in the previous question. The only difference here is that you'll notice that the cash interest that's going to be received by Glee is your PMT, which we've already calculated. Our interest revenue, again, we're going to use the carrying value of the note and multiply it by 12%, not 10%, but 12%, because 12% is the yield. And each period we'll get an amount for interest revenue based on that calculation. Now, here's where something different comes in again. Don't forget, we're going to be getting cash interest. Part of that's going to be included in our interest revenue. But our cash interest that we receive as Glee and the interest revenue we book isn't the same. So we're going to debit our cash and credit our interest revenue. Debit cash for $10,000 if we're Glee, credit interest revenue for $11,424. So what do we need to do? We are going to be a little shy on the debit side, so we have to debit the note by the difference, right? So this is very similar to what we did with bonds. When we had discount bonds, we compare the cash interest paid to the interest expense, and any difference would be how much we're amortizing of that discount. Same thing on the asset side with the notes receivable. Long-term notes, same idea. When the cash interest payment that Glee in this case would receive is different from the interest revenue it books, we are going to debit or adjust our note upwards by $14.24, which means we're going to amortize part of the unamortized discount to open the period, so we're only going to have $33.80 left. So now the carrying value of our note will be 95. I'll just do a little calculation here. It would be 95,196 plus 14.24. 14.24, and then we will get in total 96,620. So this 14.24, it's very clear it's coming from the column where we debit the note receivable or amortize the discount. Similarly now, when we go to year 2, that's the carrying value of the note to open year 2. We multiply it by 12% to get our interest revenue. We compare that interest revenue to the cash interest that we as Glee would receive, because again, it's an interest-bearing note and we're going to use the coupon to calculate the amount of interest we get. We compare those two amounts and we can see that the amount of discount that we're going to amortize, or the debit to the note, is the difference, $15.94. So now we're only going to have $17.86 or $33.80 less $15.94, which is $17.86 left of unamortized discount. So how do we calculate the carrying value of the note? We're going to take the $96,620 that opened year 2, and we're going to add to it to increase the carrying value of the note by the amount of the amortized discount. So we're going to have $98,214. Take 12% of that to calculate our interest revenue. Compare the interest revenue to the cash interest received, and again get an adjustment for the note, a debit of $17.86. So now we have no more unamortized discount, and we wind up at the end of the year with a noted carrying value, which is exactly what we said we should, because Glee expect to receive $100,000 from SAD. So Glee now knows that the note is fully matured. So what journal entries are we going to do? Well, I think I'm going to see if I can show you as much as I possibly can on this little screen here. We said this is the cash interest that Glee was getting, so you can see we debit cash when we receive it year 1, $10,000. We also said that we're going to debit or increase the note receivable, so again I've got purple matching purple here, right? $14.24. And interest revenue is going to be credited by the amount in the interest revenue column. And I'm going to do the same thing for each period. I'm going to take what's on my table. So in year 2, I'm going to take $10,000 as my cash that I receive as Glee. I'm going to also debit my note receivable to increase it. And I'm also going to credit my interest revenue, $11,594 in year 2. Year 3, similar thing. I debit cash, I debit my note receivable, and I credit my interest revenue. So now you can see where we have a situation where the note is interest bearing and the coupon is not equal to the implicit or the market rate. We now are going to have to have a compound entry with 3 lines, right? Because we have cash coming in that's different than the amount of interest revenue we book. Again, at retirement, we're going to debit cash and credit the note receivable, and again that's at the end of year 3 for $100,000, because presumably SAD has paid Glee back. To do our financial statements, again we said that the popular treatment would be to present them at net, which we've done here. All right, at net, what we would have is at the end of year 1, we'd have 96,620. At the end of year 2, we'd have 98,214, right? And at the end of year 3, we would have nothing. So it's not applicable because, again, we'd be making the assumption that at retirement, which is the end of year 3, the note would be credited by Glee when cash gives them the cash. So there would be no more note receivable on Glee's books. Notice here in the statement of financial position, the note at the end of year 1, because it matures in year 3, is a long-term investment, and at the end of year 2, it's a current asset. If we wanted to use, again, this column is grayed out because it's not a typical presentation, but you could do it this way. You could take your $100,000 note and deduct the unamortized discount each year to get the note at its carrying value. So at the end of year 1, if we deducted $33.80 from $100,000, we could see here that we would have our note receivable at net, just like we do here, but there's a little more detail down here at $96,620. Similarly, we can see at the end of year 2, we have unamortized discount of $17.86, such that when we deduct it from $100,000, we would wind up with $98,214 as our net receivable, our note receivable at net. And we have the same thing here at the end of year 2. All right, so, and again, you'll see here that we don't have a statement of financial position prepared in year 3 because, again, we would be assuming that at retirement, SAD would have paid GLE and the note would no longer be on GLE's books. So we would no longer have any balance in the note receivable account. So this concludes part 2 of your video on notes receivable.